good afternoon, everybody. It's actually a great pleasure to be here on this first webinar organized by Recap. I think Florian is having some connectivity issues, but yes, he's back. So this is the first series of a series of webinar we want to host. A bit of the background about why we want to host this webinar, since we've launched a platform end of December last year to provide recurring revenue financing. We had really awesome discussions with lots of founders and companies about topics pertaining to finance, and especially how to structure the best capital stack. And this is a topic that's super broad, super tricky, and super fuzzy. So we thought this is a great idea to share our discussions with a broader audience. So this is us. So about me, I'm Director of Finance at Recap. So I'm here to moderate, also include in the discussion also my opinion. As a bit of background, I used to be a debt investor, so this may transpire at some stages in the discussion. And we have three awesome guests with us today, and that's Tobias, Max, and Florian. I think I just leave the floor to you to introduce yourself quickly.
Well, then I take the opportunity to go first. I'm VP Finance at Usercentrics. And what we do at Usercentrics is basically content management. So all of you may have seen those pop-ups coming up when you enter a homepage, at least on European ground with GDPR. We are the technology in the background and serve more than 1 million domains right now. And last year we merged together with back then our biggest competitor, Cookiebot. So nowadays, we are serving a long tail of customers with the solution, as well as big enterprise customers like Porsche, Mercedes, Zalando. And I myself come also from an investor background. So I have been with Heinemann Investors and was lucky enough to do the seed round in Usercentrics. And now I can luckily support them from the operative side.
All right. Let me take over. So I'm Max, head of finance at talentsconnect. We are an HR tech company that helps you with our software to drive the attractive talent you need. So it's a career page, but also analytics behind it, and we outperform other career sites by up to 4 times. And I joined this company 6 months ago. Before, I also had a background in gross debt / mezzanine. So that also might show you where I'm coming from.
Yeah, then I go probably last. Florian is my name, venture capitalist here in the Berlin ecosystem since 15 years now. So I've seen other crises before, actually been around also during the 2001 crisis. And Project A just started the 4th fund. So we continue to invest even in the current environment, and we are typically an early stage investor, so seed, pre-seed, Series A. Yeah, that's basically us.
Awesome. Thanks a lot for the intro. To set a bit the theme of the discussion, I mean, the title of the podcast, the webinar is Cash is King. And what is the optimal capital stack for companies, and why should you care? I mean, obviously, this is a very broad subject. We could spend hours discussing this, but the way we thought about having this discussion was just to have it as an exchange of opinions, so everybody can convey their message across, what their learnings are, their experience, and what they would probably recommend to other people in the audience that maybe asking themselves the exact same questions right now, especially in the current environment. Maybe I start. I'm very rude and I'm going to start myself. One of the things I've noticed, and I think this is also part of the decision for me to join Recap from actually a bank or a different environment, is that when we talk to different customers, and especially for companies that are asset light, that have an asset light business model, I think these companies may incline to leave many growth options on the table by just being purely equity finance and sacrificing some growth option because of various reasons. We can go in there in the discussion. and that's how I feel about the topic of capital stack for asset-light companies. Maybe Tobias, do you want to give a bit, I would say, your statement, opinion about this topic?
Yeah, sure. I'm happy to do that. And I may would even build a bit up on your statement, because I would bring up the thesis of capital efficient business models are going to be the winner in the next few years. And if you are a capital efficient model, if you know how your business model works and kind of what levers to pull and where to throw money on to get what out of it, then you are going to be a winner, because then you can also leverage the full side of possibilities there. Then it also makes sense to get some debt and just grow in an efficient way. Otherwise, if you don't really understand your business model and you are not that capital efficient, it's going to be tough, because I feel growth at any price is over, because money is going to be more expensive and probably investors are going to be more selective.
Okay, that's thanks a lot. I think it's very interesting. I'll be keen to hear what exactly you mean when you say about capital efficient structure. This is also a very vast subject. Max, on your side?
Yeah, I think next to capital efficiency, it's also a lot about predictability, like how much of your business going forward can you predict. If you can't predict it at all, please stay with equity, because if you don't know where your business will be in 1 to 2 years, that might be a burden you can't service in a year or two. But on the other hand, of course, if your company matures and you can see where you'll be in a year, like to a certain degree of predictability, then not putting debt in your capital stack, it's just foregoing shareholder value creation. You can have, and you say, I don't participate because I don't want to have debt.
Thanks a lot. And Florian, do you have any statement, opinion?
Sure. Probably let me add to what you guys said, and then add one other aspect, if I may. So I think it fits, as you also said, Tobias. I think it fits right into kind of the current time, that you need to be more predictable in what you do, and basically on a KPI level, really understand what your business looks like, and also show like improvement on the KPI level, on the per user, per contract, or whatever level, and so that fits into the capital efficiency kind of paradigm that now comes up. But it also allows you to like tap into to debt possibilities. And I would 100% agree with you, Max. I would not, as long as you don't have a proper understanding and a grip on your business, I would not enter the phase where you leverage the business with debt. So 100% agreed. I would probably add one other aspect here, which I think is also part of the capital stack. I think what the next few months will definitely also show, or have already shown in the past few months. I think it's really important to also look who you take your money from, on the debt side, but also on the equity side. Because there's very different ways how to treat a kind of crisis. And you will have to rely on your existing investors a lot more, probably over the next few months than that would have been the case in 2021. So I think really trying to find out who are funds that have reserves, that where the funds duration cycles are still going on for quite some time. Also, if you take on debt from debt funds or whatever, you really have to understand how long are their fund cycles, because that will also influence how they will behave when you need more money from them. So I think being quite cautious on who provides money to you on the debt and on the equity side, I think is, and also being diversified there. Not just rely on one investor, but try to rely on several sources. On the debt side, that's a little bit difficult, obviously, but on the venture side, that's obviously possible. On the equity side, so that's probably one aspect I would also look for. One thing that adds into that is probably not always take the one with the highest valuation, on the equity side. So that could be the right strategy if everything goes well, then that's the right strategy. But I think the last thing you want to have, and I think that's what we see right now with quite creative ways also in our portfolio. Everybody wants to tries to avoid a down round. Yeah. So, and obviously you can do that by adding debt to the mix. But also you see quite creative ways of, structured rounds right now. And obviously it's a lot easier to avoid down rounds if the valuation you took in 2021 hasn't been completely crazy. And I think that is always something to keep in mind. I would rather take a more reliable, steady partner, for 25% less valuation or 20 or wherever the threshold is, where they are reliable partners also in a crisis situation than the one that pays you the highest valuation. And I think now this time already teaches us that is probably right.
Thank you, Florian. I think this is also a very broad topic as to which partner is the bet, not just what kind of instrument you use, but who are you actually entering into partnership with, and the trade-off between getting the best deal on a one-off basis with a bit of opportunistic partner as opposed to getting the long-term relationship. We'll get to this point in the discussion. For people in the audience, you have the opportunity to ask questions in the chat. We will combine them, review them, and then answer them at the end of the discussion. So feel free to shoot any message you would like. I think we were discussing different way of diversifying for maybe people who are not familiar with all the instruments that are available, because it's a bit of a jungle out there in terms of what instruments are. And I think it's helpful to mention, of course, we have equity provider, which is the go-to product, especially for companies that are asset light. But there are venture debts. We have recurring revenue financing providers like Recap. We have revenue-based lending. We can have buy now, pay later, asset-backed lending. I think the landscape is very broad. Maybe starting with you, Max, what kind of instruments, if you'd like to disclose, what kind of instrument have you looked at? How did you, set your strategy on which investment instrument you actually wanted to use in your company?
Yeah, actually, we have 3 in our capital stack right now. So first is equity, which is the cornerstone of the capital we have here. And then this company is already 9 years old, and it took some time to really carve out the product we have right now. But once that was done and we saw the proof of going to the market and had first big customers, and not only first big customers, but several big customers and also several smaller ones, we thought, okay, now let's try to enhance this and try to scale this company to a 10 million ARR figure. But because we thought there's a lot of predictability in it, we said, let's try to find something that's not pure equity, and we went with a mezzanine provider. We also had some smaller bank loans in there, and that's something we now also use Recap for that kind of bank revolving credit loan facility kind of money. So those are the 3 components we have. We have pure equity, we have mezzanine, which is long term but has more debt elements in it. So it's not non-dilutive. It has a small dilutive element, but it's much less dilutive than equity. Because we just see, okay, if we can predict our growth very, very well and we can achieve it, then this will retain a lot of the shareholder value for our shareholders. And then, of course, for revolving credit facility like items, we now use Recap.
Great. I mean, obviously, we're super happy about this, but I'm a bit biased. Tobias, maybe you want to give a few words on what instrument do you use? Have you looked at? What's your strategy at the moment?
So right now we are purely equity financed, but now we are also getting to a stage, or we are already at a stage where it makes a lot of sense to get in other possibilities of financing like debt financing, and therefore we are looking at revenue-based financing as well as venture debt. And that ties, I think, very well into also what Max said and what Florian said before. It's just now we feel that we are at a good point where we understand our business model quite well, and that we know if we invest X on top, we get Y out in the end, and therefore it starts to make sense for us that we leverage also debt.
Yeah, that's obviously, it's a super important point. I'm just going to go back to this one right after. Maybe Florian, from your perspective, as a VC investor, obviously you see everything. Companies that are purely equity finance, companies that have a bit, I would say, more diversified, maybe even exotic financing structure. In your opinion, like how do you advise companies that come to you with this exact question? And have you seen any trends or changes in the way companies are financed at a specific stage compared to, I don't know, a couple of years earlier?
Yeah, I think, I mean, what do we advise typically? I think as long as you don't have a clue, just be based on equity. And then the more clue you have and the more grip you have, the more diversified you become, in terms of the debt instruments that you can use. And I can only encourage people to look at the various options. And we also are quite involved in private equity co-investments, so we would be too long to explain now in detail, but we invest quite a lot with mid-market private equity firms. That's kind of a second business line that we do at Project A, and it's fair to say that a significant share of the value creation that those private equity players are somehow developing is coming from the capital structure or the financing structure that they use, especially on the debt side. So I was quite amazed, because if you come from the VC world, you always try to achieve operational progress, and that leads to value creation. That's kind of our logic. And then you see how the private equity players are doing it, and you kind of it's, for me, was kind of a revelation. To see how much value is actually created just by having obviously very good debt conditions, because they also do that as a fund on a regular basis. So we're talking about profitable businesses. But anyway, but it's not a 0-to-1 discussion. It's not an equity only versus you are like a private equity player, but there's something in between. And I think the moment you start to have a grip on your business, so I would start to look at all the possibilities that are there. And I think from that, we also encourage companies like from a Series B type onwards to also have a proper CFO that really understands the effects of this. So and really is able to assess the various instruments side by side each other. And typically, I mean, what you see in a Series C, D type company is that they combine all of the possibilities we discussed. So they have an equity portion, but they also use regular bank debt to finance an acquisition, for example. They have venture debt, and at the same time they use revenue-based financing to optimize their cash flow. So you'll see usually all those instruments kind of bundled together depending on the business. And I think my advice would be the moment you feel you're onto something, probably start to invest in the internal capabilities to assess this. And the CEO cannot just do that on the sidelines. I think that's and it's time well spent and resources well spent to invest in a finance team, or like at least a proper CFO, which you will need anyway. If you want to be really successful sooner or later, you will need that person anyway, and to assess those possibilities. But yeah, that will probably be my advice.
Yeah, I think this is a super crucial point, and I think Tobias mentioned this when he said, now that we actually know what's coming in top line, we can actually decide what a finance instrument is relevant for us, and if diversifying of a capital stack makes sense. When we talk to companies, we often have also the discussion about, especially a few months ago, with the feeling to some companies like, well, we've got enough equity to go ahead. And that's true. And you could say, well, of course, you can keep your business purely equity finance. But building up on what Tobias said, my opinion is as soon as you know what your customer acquisition costs are, and you have a feeling on how long it takes to get them back, to get the CAC payback, I think as soon as you have this, you can actually start thinking about leveraging this position in your P&L, and then having a solution like recurring revenue financing, or the solutions that allows you to, bring forward your revenues, so you can reinvest this in new CAC that you know exactly when they are going to generate new growth. And I think, of course, the point is crucial on how, like, when do you get there? Maybe Tobias, just it would be interesting for me. Like, how long did you need to actually get to the point where I say we actually understand our financials and KPIs in our product and the sales cycle to be able to make a decision? Do you have any advice you can give to people in the audience on how you manage to get there?
That's quite a tricky question, I would say. And
sorry,
in the end, the answer is it depends. It kind of depends, especially for us, because I would have to differentiate between our different products. We have a self-service product, which is our CookieBot product, and there it's definitely easier, and you can get to those solid numbers way quicker. It's just quite important that from the beginning on, you set a focus on getting the data and interpreting the data in the right way. I have a feeling that quite a few companies have this focus too late, and just too late get to that sense that they really look at the data and make data-driven decision based on that, even though they may sit on quite a data-rich stack. On the other hand side, for our Usercentrics product, which is rather an enterprise sales, and there it's different. It took definitely longer because enterprise deals are different. They are kind of unique always. It depends on which customer you are talking to, and then you just need some more time to figure out what is the overall sales cycle and how does this product work, like in Germany, how does this product work in other countries in the European market. And there it just took us a bit longer to really understand what are our real customer acquisition costs. There, I think it's a bit tougher, but therefore it depends. It depends a bit on the product. It depends a bit on the market you are selling to, and it depends on your target group or your target audience. But it took us quite a bit of time because we didn't build the focus in the beginning.
Yes, I fully get the, this is an iterative process where you start with a lot of assumptions, and then time after time, these assumptions become actually backed by numbers and facts. Max, do you want to give a bit your experience in that area? Because you've diversified already your capital stack. And how did you combine this, like, with your, I would say, growth map on the finance side and your capabilities on the finance side?
What do you mean by growth map on the finance side?
I would say your development stage in terms of be able to track your own performance, KPIs, understand your numbers thoroughly. Was it that at the beginning when you first starting diversifying, it was a bit of, not like a bet, but say, okay, let's use this opportunity and then we can reconvene and see if we want to continue it? Or was it more like a front-loaded approach where I say, okay, I know exactly my numbers, and now I'm going to diversify?
Yeah, actually, I think it ties into what Tobias said. So we had a solid growth base last year and said, okay, now try to scale that up a little, invest into our sales capacity. We hired several account executives and SDRs, but we said, okay, if we take the performance, the customer acquisition costs we have had so far, and scale that up, then we have certain predictability in there, certain room for error. But that's also why we did not use venture debt or anything like that, because that's very short-term oriented. Let's say 1 to 2, maybe 3 years. And if you don't have the proof of concept, you kind of have no room left for error. That's why we went with a mezzanine product that's still very long-term for that investment. And now we're doing what Tobias has said with our new cohort of new salespeople. we are trying to build, or we are building up the data. So we started doing that, but it of course takes some time. Let's say your sales cycle is 3 months, then you don't have any data for these first 3 months. So it just takes time. And once we have a certain proof of that, you can start investing more short-term capital in those certain cohorts. And even if it's just, let's say we do performance marketing on LinkedIn, like we track that separately, LinkedIn is Xing, we see different effects there. And then if we say, okay, one is really outperforming the other, and we have a quick return on our investment, then we might try to use other capital for that.
Yes, absolutely. I completely agree with you. One as a follow-up questions regarding this, I think one topic I wanted to touch upon, and I'd be also very interested to hear all the opinion, but also Florian's opinion about this. Right now, the market is what it is, and I think the times of just raising equity super quick, it's becoming a bit more difficult for everybody. So my feeling is that now a lot of founders are confronted with sort of the dilemma. Do I invest in growth or do I preserve my runway? So, and it's kind of a lose-lose situation, because actually you want to preserve both and to keep both. We see obviously from us as Recap revenue, recurring revenue financing as a way to, find a middle way and actually keep the best of both worlds to the largest extent. But what do you advise companies when they come with this exact problem to you, Florian, where they say, I have to make a choice and I'm not sure exactly what is the right decision to make?
Yeah, that's probably the $1 trillion question. No, but what I always try to tell people, I mean, in the end, founders have to take their own decision. But I think, if you think back 5 years ago or 10 years ago, a financing round, you probably had to account for, or you basically had to allocate 6 months for that to happen. Yeah, so that was kind of a normal thing. So you advised kind of the founders 18 months of runway is not bad, because after month 12, you have to start fundraising if you want to get it done. And yes, if you're the hottest shit on the market, you get it done faster, but it was completely normal that it took 6 months. That didn't, it wasn't a bad company. So I think now, I think 18 months is the absolute minimum that you should go for in terms of runway. But I think it really depends on your internal financing, like the investors you already have on board. Yeah. So I would just keep my main advice is keep in sync with your existing investor base and try to understand, okay, are we all committed, to you guys financing us in 12 months if the round or the overall market is not working? Yeah, like right now, it's obviously kind of difficult for some companies, and I think it will become more difficult in the next few months. So I would just keep in sync with your existing investor base and say, okay, if you're not able in 12 months to raise a round, will you be able to finance us? And I think that's kind of the key task for the CFO and the CEO, to keep in sync with the investor base to do that. But I would definitely, return to the kind of framework we used to have a few years ago. So rather 18 to 24 months of runway. Yeah. If you have a strong grip on your KPIs already, use something like revenue-based financing, add some venture debt to it to add another 6, 7, 8 months. Yeah. Definitely make use of that and secure the lines also today. Yeah, because some people say, I can still do that when I feel I need it. That's not a good idea. Yeah. So because if you feel you need it, there's a slight chance that everybody also feels they need it. And then so if you have the chance now to secure some venture debts, talk to guys like you, and I would secure that, even if if people feel it's a little too much or a little too expensive. Yeah, there's nothing as expensive as running out of money. Yeah, so that's probably the main advice. And some people are even more drastic here and basically say you should rather have 3 years of runway. Yeah, so but I would definitely say, I mean, what we definitely see I mean, it used to be you needed to grow 100% plus every year, otherwise you are nothing. Yeah. So in the last 25, 30%, or the second 50 cost you significantly more than the first. Yeah. So, and I think now if you are a later stage company growing 30, 40, 50%, that's completely fine. Yeah. So I think rather conserving cash and being able to have like 1 year more runway, I would definitely do that. If you grow 10%, then you're not a growth company anymore. Yeah. So I think whether the threshold starts at 25, 30, 50, that's kind of a philosophical question, but not everybody has to grow for like 100% plus on expense of the runway. So I wouldn't do that. So I would really think about or try to understand the elasticities of your growth, and then agree with your board or your investors or whoever is kind of responsible with you. Should we rather go for 50? Should we go for 30? Or should we still go for 100 on expense that we just have like 18 months of runway? Yeah. So I think that has to be kind of a common implicit kind of contract in the shareholder structure. What's kind of the path that you go forward? And I would really explicitly discuss that and enable the round that you're doing this with by the that's why you need a grip on your numbers to be able to even give this kind of choice. Yeah. And obviously then you have to meet your plans. I mean, if obviously Putin cuts gas or whatever, then all plans are obsolete anyway. So you always have to have a certain buffer. But that's kind of, I don't know whether it really helps you, but those are kind of at least some of the thoughts that I would provide. Yeah.
Yes. Yeah. Maybe as a follow-up question to Max, also in that area, since you've onboarded a financing solution by Recap. In your motivation, I mean, the way we see it as Recap, we say, okay, with our product, you can either, there are two ways to look at it. You can say, well, with your existing runway, you can make the most of your growth, or you can achieve the maximum potential growth without having, I would say, the high cost of equity involved with, achieving the same amount of growth. Can you give us just a quick feeling on, how was your decision making about this? Did you look at growth? Did you look just at the price of growth? What was your driver in the decision?
Actually, our first decision tied into what Florian also said, that let's secure something now that we might be able to use later. So we said, let's sign a framework agreement, because it doesn't come with any strings attached at first. And then we can look at it later and see, okay, can we use this now? It just happened by chance that we had a situation where we said 2 months later, hey, now's a chance to use some of it. And then generally, I totally agree with what Florian said. You cannot be dependent on any unknown in the future. So you need to be very sure that in a year or two, you don't need any money, or you know how to get it. And I think Recap doesn't even give an option for more than 12 months. So it's still nice to have it as an option in your basket, because in the end, to keep unknowns low, have many options, be diversified, talk to your existing investors, have a good relationship there, but also, see what options are there, because having options never hurts.
I think what is quite important to add there, don't build plans last minute. I have a feeling that some companies are now getting in that situation, and the pressure that they are asking for debt and reaching out because they thought it will go on forever like this. And then the other one is align with your investors. And Florian made a really good point in just highlighting that one. Be aligned with your investors and be aligned what you agree on. How much do you want to grow, and what does it cost? Is that aligned with everybody? And how do you want to have your capital mix or stack mixed? And then build plans early on and secure a credit line if you want to draw on this in the future, but don't do it when you need it in the next few months.
Exactly. I mean, I used to be a debt investor, so obviously I'm a bit biased, but the saying is very true. You actually only get debt financing or debt-like financing when you have a lot of money. And it's important to secure this now. And I'm thinking also, when the way we know equity raising works, there's a couple of, it takes a while to raise equity, and markets can develop sometimes quite quickly. I think it's also very important at some point to have a more dynamic instrument that follows your growth. Exactly, because you can't predict everything to the last cent, and you can't predict maybe short drop in revenue or short increase in costs. These are items that you need ultimately a flexible instrument to follow you. Tobias, I would have a question for you with regards to how tricky the path is to thinking about raising additional instruments like debt-like instruments. From your perspective, in your view, maybe as a word to people in the audience that maybe think, I don't have the manpower, I have no idea where to start. What in your view are the biggest hurdles that you need to overcome beyond understanding your numbers in able to actually starting onboarding other source of financing as equity?
Probably the biggest hurdle is getting it started and get the ball rolling and start to talk to people. I mean, start to talk to Recap, start to talk to other providers, debt providers out there in the market. I feel that is sometimes kind of the biggest hurdle you really have to overcome, because there's daily business, there are things going on that may keep you busy, but then it's just a project you have to drive, and just getting into the conversation, understanding what debt investors or debt providers are looking for, what they want to see, then you get a better picture of where are you in that process? Are you already there? Do you have everything together that you want to show them? Is it quite a big effort? Or what is it actually that you have to work on? And then also on the other hand side, align with the rest of the executive team and align with your board, align with your investors, if that is the path you want to pursue. So it's kind of those two streams you have to follow up with. But I feel it's rather about getting it started and get into those talks with the people.
Yes. And Florian, in your experience, do you feel that, you as an investor, you have a lot of awareness and experience with other kind of capital stacks that are just purely equity raised. When you also discuss with other investors, do you feel that there's still a lack of awareness of other options that are available with some of the investors? Or is it something that has improved? How much, in your experience, education needs to be done also with maybe smaller investors about this kind of product?
Yeah, definitely. I mean, if you look in Silicon Valley, I think I read a statistic recently that I think 60 or 70% of the Series B plus companies or Series A, I don't remember exactly, had some form of venture debt. Yeah, and I'm pretty sure that in Germany that number is definitely lower. Yeah, and also some preconceptions or kind of prejudice against, taking on debt, and it can be, I've had bad experience with that, and so I think that it's definitely an education issue. And I think venture debt is still, I think, relatively known, but that there's more forms of debt, and not all and not all debt is structured equal. And because then you have providers like Silicon Valley Bank, where people often think, oh, they're just providing venture debt, but that's not, they're providing a whole range of products. And so working with Silicon Valley Bank doesn't necessarily mean so they have venture debt or whatever. So it's and I think that's why I think it's so important that you have one person at least in a startup that starts to grasp the whole range of options that are out there. And understand where it's applicable and where not. And obviously investors can help there. So what we try to do, at least, we have a CFO here at Project A that tries to keep track of the various options that are in the market, and also tries to actively recommend the options to the respective portfolio companies where it fits. But obviously, you need to invest in those kind of resources also on the investor side. So a smaller investor couldn't do that because they don't have the management fee to pay for something like that. So again, I think that's why it's important to have things like this webinar, but a lot more, so that people start to understand that it makes sense to invest in this knowledge, and also as you've seen, I mean, like revenue-based financing, etc. All of that is relatively recent to the German market. Yeah, so I think that's also the thing. It's not just that that the people are not so educated in that regard. It's also that some options also just became available 2, 3, 4 years ago. Yeah, so and I think that's another aspect, and I'm pretty sure that the market will continue to diversify in the options that are out there, and existing providers of certain debt instruments will branch out and will provide more debt instruments. Yeah, so I think it really pays off for individual companies, but also for investors to understand the options, because that's the thing. In the end, early stage investors like us and founders are kind of in the same boat on this. Yeah, we all the better we understand how how debt options work, the less we all dilute. Yeah, in that sense, we're really aligned. So everybody has an interest on the equity side, but also on the founder side to explore those options.
Yeah, the topic of valuation, sorry, Max, dilution is also a very important topic in the decision making. I assume, Max, this is where you want to jump in. Feel free to react, and I'll keep my question.
Yeah, I actually want to pick up on Florian's earlier point that people need to try to educate themselves about the options, because if they don't have the education about it, they can't make an educated decision. Because I think many people see it as a sign of weakness to have debt on your balance sheet, but on the contrary, it's, in my opinion, more of a sign of strength, because there's a different party now looking at your company that's not only looking at the upside you have, but also at the downside protection you have in your company, and that's actually a good sign right now, and obviously a sign of strength in times we have now.
Do you have any tip or resources that you would recommend to people who actually also want to educate themselves on this topic, besides talking to different players and attending webinars?
I would pick up the phone and call somebody who has had experience with it. I think that's always best. It's difficult to just get it by reading through it. Yeah.
Yes. That's great. I'm looking at the time. I think we have time for another question. I think I would very much, Tobias and Max, would like to hear from you. The topic of valuation and dilution. This is obviously a very important topic beyond the financing need. How much does that play a role in your decision to diversify your funding or not? Is it priority 1, priority 2? You look more at the funding need on the operation side. How does that play a role? Maybe Tobias, do you want to start?
Well, probably one thing which we already hit on early in the beginning is don't let your capital stack decisions be driven by valuations. I think that is always one of the first and major rules. Therefore, also meaning with that, don't go for the highest valuation, because they can just fall on your feet later on. But then that definitely plays into that game of bringing in some ease there also for founders and early stage investors, that it can make sense, that they don't dilute too much. So it's definitely a thing to take into consideration, and that's what we do as well. But I would highlight there again, connect with your investors, talk with your board, and also get a feeling for how is the mood there, how is the opinion about things, and probably you can also play an educating role there and just show them some efficiencies you can gain with that, and show them the possibilities. Maybe not everybody's always aware of that. And Max, do you want to add anything to this?
Perhaps to add, don't only just pick the money with the highest valuation. Also, don't just pick the money that's most available. You should always have options. And in the end, of course, that is always about avoiding dilution, giving value to their shareholders.
Yes, that's very good closing words, I would say. Looking at the time, I think we've gotten a couple questions asked. The first one is, can you please explain in simple terms how bank financing, venture debt, revenue-based financing differ or equal? This is actually a quite broad question. let me put this in like in words as simple as I can. Feel free also, maybe also Florian, Max, Tobias to interject on this. I think in terms of, bank financing, we mean traditional corporate loans that are on the balance sheet. They usually follow a cash flow approach. So oftentimes you need to be profitable to get a loan, so you can show your repayment capacity. Venture debt is a bit more on the, I would say, growth stage kind of companies where you may not be profitable yet, but at least you have a loan also on your balance sheet that is deployed and can be coupled with a couple of milestones that you have to fulfill. Also follows a quite traditional repayback schedule. There may come collateral with this, so you may need to pledge a lot of your assets to be able to pursue this loan. And oftentimes it comes with an equity component that you have to get a warrant in there. Revenue-based financing and recurring revenue financing, these are categories that often mix and match. This is a more dynamic way of looking at lending. You advance against future revenues. So you take the view of a debt investor, but you advance revenues to a specific time horizon. And in revenue-based financing, usually your repayment schedule is dynamic, also to the amount of revenues generated. In recurring revenue financing, you tend to stick to the original revenue, I would say, payback period that you've agreed upfront. Typically, these do not bear securities the way venture debt does. I hope it was not too fast. I hope that answered the questions. I think there was another question on where do you think interest rates are heading for debt instruments? This one, I think, I can ask in the round. I don't know, maybe Florian, do you have an opinion about this one? I think up would be my...
Another trillion-dollar question. Where are the interest rates heading? I think the only thing that you can say is upwards. Yeah, I think that's for sure. So I think you already see that. I mean, if you also see that when you buy an apartment. I mean, if you had a good credit score 10 months ago, you would have gotten it 4% or even less if you want to 10-year of interest rate kind of fixation. And now you're talking 2.5 to 3.5%. Yeah, so. Things go quick, and on venture debt, you used to be below 10%, and now you're significantly above 10%. If you and some people try to offer you more like a floating type rate, yeah. So which I don't know whether I would do that, but sometimes you cannot avoid it. So you're well above 10, 12% probably on the venture debt side. Yeah, on the revenue-based financing side, you have to probably say that, Mélanie, but. Definitely interest rates have gone up, and let's see how it will. I mean, some people claim it's already the ceiling. I don't think it's a ceiling already. I mean, if you look at what the Fed is doing and the ECB will be doing, it will go up, but that doesn't necessarily have to do with the actual rates you're paying, as we see right now.
Exactly.
But probably it will go a little further up, and the higher, the more crisis we have, and the bigger problems we have. The higher, the more we will probably see rates rising. Yeah.
Yeah, absolutely. I think this one is a tricky question because there's obviously a time lag between decision of central banks and how that transpires in the economy and in financing conditions. But I think we all agree that the direction is probably going to be upwards. The last question I have is. From Tobias, if I understood correctly, Recap is trading AR for a share of equity. This is not correct. We are not taking equity to trade ARR. So I am happy to give you insights into our business model. Also, you feel free to contact us if you have any more question on this. We basically, in a nutshell, we allow you to sort of pre-finance your ARR with a specific time horizon and discounts based on a couple factor, but we do not take equity as part of the trade. if there are any more questions in the audience that you did not want to ask now or you forget about this, feel free to contact us also. You can find contact page, the contact details of Recap on our website. Also questions to Tobias, Max and Florian. We're happy to send them over if you have specific things to ask them. Otherwise, I would say thank you, everybody. Max, Tobias, Florian, it was really great to have you. Thanks you for taking the time to talk to us. I hope this was interesting to our participants. I mean, I really enjoy discussing finance and capital stacks with other parties. We will send a link also to a newsletter. Feel free to sign up to a newsletter. Exactly. We're looking at setting this webinar series into further episodes. If you have also any suggestion on which topics you would like to see covered in the next session of the webinar, feel free to reach out to us. In the meantime, I would say thank you very much. I'm just looking at the chat.
There's one more question. I don't know whether you saw that, Mélanie.
No.
On top, what business model lend themselves particularly well for this form of financing? I assume
Recap. Yeah.
Recap.
I'm assuming Recap as well. Thanks you, Florian, for pointing this out. Basically, any sort of business model that has recurring revenue. So it could be subscription companies that have a subscription kind of business models. These are a great place to start because of the predictability that Max talked about. When it's easier to get advance on revenues when they're actually very predictable. So obviously, SaaS companies are a great vertical to focus on. There are other verticals that are also interesting. We cover a wide range of companies, so we can start also quite small. It could be 100,000, 200,000 ARR, up to 10 million, 15 million upwards. Then there is no a specific cut where we would stop providing financing. I think that should be it. Yes, great. Thank you, everybody, for your time, and see you at the next webinar.
Cheers.
Bye.
Bye.
Bye-bye.
Thank you.